Investing your money is, in my opinion, the best way for the average person to grow their wealth over the long run. But with so much information out there and so many different choices for you to choose from, it can be a bit challenging for you to even know where to start. So today, with this video, I'm going to cover the basic information so that you can at least get started with your investing journey, and I'll cover how you can invest your money, what you can invest in, and why you should invest your money in the first place. Let's get started. First off, what is investing and what are we doing with our money when we invest it? The easiest way for me to explain investing is that we're essentially putting our money to work in the hopes that it will generate returns for us and make us even more money. I think the easiest example that you can give is with property. So let's say you want to invest in a property, you buy one for $300,000. Obviously the hope is that in the future, the value of this property will go up, you can sell it and then you can make a profit. So investing in all of the other asset classes, it works in pretty much the same way, but I'll explain how you can make money from investing later on in this video when I explain what you can invest in. Before we get there, let's cover why you should invest your money. So I won't explain too much into this because obviously I don't need to persuade you guys. The fact that you guys are even watching this video means that you kind of want to invest your money already, right? But I thought I'll just share some numbers anyway because it is pretty mind-blowing. So the main reason that people want to invest their money is that they want their money to, passively grow by itself so that they don't have to just rely on their savings to build wealth. So let's give you guys an example. Let's say you want to have $1 million saved up when you're 55 years old for retirement, and right now you're 25 years old. So you have 30 years to go, or 360 months, which means that you will have to save $2,777 every single month starting from today. It is possible, of course, but it can be a bit challenging, especially for people early in their career because our incomes aren't that high yet. But what if you invested this money instead and you got a 6% return every single year, which is, I guess, pretty common in the stock market? But basically, with a 6% return every year, you now only have to invest $995 every single month to get that same $1 million portfolio when you retire at 55 years old. So if you just save, completely just save your money, keep it under your pillow, you will need to save $2,777. If you invested it for a 6% return, it's only $994, or roughly 30% of the amount of money that you need to save. Of course, you still need to work, you still need to earn money because you need money to invest in the first place, and you're mainly going to get that from working. But to me, investing is really the only way for you to make your money work for you and grow itself over the long run. Now that we've covered what is investing and why you should invest your money, let's talk about what you can actually invest your money in. So this one, I'll focus more on the Malaysian lens. So these days, there are so many different asset classes that we can choose from. Apart from, the traditional stuff like stocks and bonds, there are so many other options that any retail investor can invest in, like crypto. You can even invest in loans, and there's even platforms that allow you to invest in artwork. But I'd say that those are a bit more complex. So for the new investor, for people who are just starting out, I would focus on the 4 major asset classes, which are stocks, bonds, commodities, and cash. So I'll go through every single one of these. I'll explain what they are, how you can make money from it, and also where they sit in terms of risk. So the first one that I'll be talking about is stocks, and it's actually the most common form of investing. So when you invest in a stock, you're actually buying an ownership into a company. I guess, if you're buying stocks of big companies, you won't really have a big ownership, but you are taking an ownership in a company and you're hoping that the value of the company will go up over time so you can sell it for a profit. For example, let's say if you bought Apple 30 years ago, you invested $1,000 back when it was an unknown company and didn't have many products yet. If you held it until today, the value of your Apple investment would be $363,000. Just because, over the last 30 years, obviously Apple released the iPhone, they're the App Store, and it made so much money and the value went up. So yes, that is how stock investing works. But you won't actually see this money in your bank account. You won't see $363,000 in your bank account. You'll only recognize these gains when you decide to sell your investment for a profit. It works very similarly to property, Let's say, like I said earlier, you bought a house for $300,000. Today it's worth $500,000. Perfect, but you don't actually have that money in your bank account until you sell it. But there's another way that you can also make money from stocks. So sometimes companies would pay dividends. Dividends are basically companies paying out a percentage of their earnings to their shareholders as some form of reward. So for example, one of the more popular dividend stocks in Malaysia is Maybank, and they're currently giving a 6.5% dividend yield. So let's say if you invested 10,000 ringgit into Maybank today, you would expect to get maybe around 650 ringgit in dividends a year. Obviously, this is not guaranteed because it depends on how much dividends they decide to pay, which will depend on how much money they make. But some stocks, they're known for giving in a lot of dividends and they consistently grow these dividends every single year. So this one, you don't have to sell any shares of Maybank. The money will actually go to you directly in the form of dividends. And depending on the broker you use, it will go to your bank account or your brokerage account. But the risk when investing in stocks is that the value of it can go down. Obviously you're investing into a company and the value of that company can also drop. And that's why stocks are considered high risk, high reward plays. In some cases, the value of the stock could even go to zero, meaning that you lost all of the money that you invested into that company. But obviously, the risk associated with a stock will depend on the company that you're investing in. If you invest in a company like Apple, it's very stable, it's very unlikely they're going to go bankrupt and it's going to be worthless. I'm not saying it's impossible, but it's pretty unlikely. Versus, investing in a relatively new company, a new startup who is burning cash, they're not profitable yet, the chances of them going to zero is obviously a lot higher than Apple. Moving on to the next thing that we can invest in, the next asset that we can invest in, which are bonds, and they also play a big role in a lot of investors' portfolios. So these ones, they're not like stocks. When you buy a bond, you don't technically own anything. It's more like giving a loan. So the most popular type of bonds are government bonds, and specifically US government bonds are also called as treasury bills. So anytime that you buy these US government bonds or treasury bills, you're technically giving a loan to the US government. And like all loans, the government will have to pay you an interest for borrowing your money. As of the date that I'm recording this video, if you bought a 10-year treasury bond, which means it expires in 10 years, the government will pay you a 3.9% interest per year. The risks for bonds are also a lot lower than stocks, which is why the returns are also lower. If you invested in a US government bond, the only way that you would lose all of your money is if the government, the US government goes bankrupt, which I would say is kinda unlikely. Again, it's not impossible, but it's very unlikely. The third asset class that you can invest in are commodities like gold, which I know a lot of Malaysians like. So these work like stocks in terms of how you're going to make money. You invest in gold, you hope your prices go up over time, and then you can sell it for a profit. But unlike stocks, commodities won't pay you a dividend, meaning you're not going to earn any money until you decide to sell. There are also other commodities like coffee, oil, and even orange juice, but I would say these are more for traders and not really for investors. Most investors, I think the only commodity that I know that people actually invest in is gold. So yeah, if you want to invest in commodity, that's pretty much your only choice out there. And the risk with this is also pretty high. The fluctuation of gold prices can really move up or down quite a lot. But I would say that it's very unlikely as well for gold to ever go to zero. So the final asset that I'll be talking about today that you can invest in is cash. Yes, you can actually invest in cash, but not if you keep it under your pillow, So the most popular way for people to invest in cash is via fixed deposits, which I'm sure pretty much all of you already know. But if you don't know, fixed deposits basically mean you're committing a certain amount of money for a certain amount of months to a bank, and they will pay you an interest for committing that money to them. There's also something called money market funds, which is basically a fund managed by a professional investor who will look for the best fixed deposits out there, and also maybe sometimes even different asset classes to maximize your returns. But I'll cover more about money market funds later in this video. Okay, this might sound a lot. Even though I've already narrowed it down to just 4 different asset types, there's still so many different things for you to consider. So let's narrow it down even further. This is just my personal opinion, but to me, most new investors should just focus on 2 different asset classes, stocks and cash. So stocks are the high risk, high reward play, whereas cash is the low risk, low reward play. So what we want to do is we want to use a combination of both to create a balanced portfolio. Let's start with stocks. So how are you going to invest in stocks? There are a few ways for you to do this. One is you directly invest into an individual stock for a company that you like and you think will go up in value over time. So like I said in the earlier example, Apple and Tesla, you can invest in those companies, but pretty much any major company that you know out there like Nike, Facebook, and even Google, all of these companies are listed on the stock exchange, which means you can invest in them. This will give you the highest potential return, but it will also come with the highest risk. Obviously, the risk of any particular company going bankrupt is always there, no matter how big they are. So that is the risk of investing in individual stocks. But another problem with investing in stocks is that if you want to do this, you actually have to do research on it. So you can't just blindly buy Apple and think that it's going to go up forever, because obviously it will not. You need to know how they're currently doing, how they will do in the future, and whether right now the price is right for you to invest in that company. So a very popular method that people like to use over the last 20 years or so to invest in stocks is to use ETFs. So ETFs are, think of it like a basket of many different stocks that you can just invest in by buying one single ETF. So I'm going to give you guys an example. The most popular ETF out there is the S&P 500, which is SPY, which holds the 500 largest companies in the US. So by just buying this one ETF, you will get access to Apple, but you will also be invested in 499 different companies. So this one is good because one, it's simple, you just have to buy one ETF. But two, it also means that it's a lot less effort because you don't really have to do research on specific companies because you own 500 different companies. So you're very, very diversified. I won't talk too much more about ETFs because this video might be a bit too long, but I recently did a video specifically on how you can buy ETFs and the different types of ETFs. So if you're interested, check that out here. If you want to invest in any stocks or ETFs, then you're going to need a brokerage account to buy and sell these equities. So there are many options out there, but my two favorite ones right now are Interactive Brokers and M+ Global. If you're not from Malaysia, then Interactive Brokers is probably one of the best choices out there for you because they accept investors from many different countries, but you can also check out any local options that you have. If you're a Malaysian, you can also use Interactive Brokers if you want, but if you want something that is licensed and regulated by Securities Commission Malaysia, then check out M+ Global. I also use them, they're pretty great. I'll leave the links for you guys to sign up down below. You can get some freebies if you sign up with M+ Global. With Interactive Brokers, you'll just be supporting the channel. I also have reviews of both of these platforms, and I'll leave the videos down in the description below as well. So that's a high risk, high reward part of our portfolio settled with stocks. Now let's cover the low risk, low reward side of our portfolio with cash investments. So like I said earlier, the most famous and popular way for you to invest in cash is via fixed deposits. They are pretty decent options, the returns are okay, maybe 3 to 4% a year, and pretty much any bank out there will be offering them, so it's very easy for you to invest your money here. But the main draw, I would say, is that it's extremely safe, so the value of your fixed deposit won't go down or up at all. They will just pay you dividends and then obviously your money will grow. But it's also, if you're Malaysian, it's also PIDM protected of up to 250,000 ringgit, meaning even if you put a fixed deposit with, let's say, CIMB and something goes wrong with CIMB, you will still be protected and you will get your money back of up to 250,000 ringgit. But in recent years, there are many money market funds who have launched to the public, and they are to me also pretty great options. So previously, money market funds used to be reserved to high net worth individuals just because the minimum deposits were a bit high. I think I checked before, some of them like 10,000, 20,000, even 50,000 ringgit. So that's why previously only rich people would invest in it. But with the launch of apps like Versa Cash, Stashaway Simple, it's now a lot more accessible for basically anyone to invest their money because the minimum is now around just 10 to 100 ringgit. The reason that they're good is because they're also extremely low risk, but they don't have PIDM protection, but they also give you pretty high returns right now of about 4%. But the reason that I like money market funds over fixed deposits is that money market funds, there are no lock-in periods, no commitments that you have to make. Like I said earlier in this video, fixed deposits, you're committing your money for a certain period of time. Sometimes it's 3 months, 6 months, 12 months, whatever it is, it's up to you. But once you put your money into a fixed deposit, you kind of have to leave your money there until it matures. If you want to withdraw your money, most banks will allow you to do it, but you will be penalized, meaning maybe you lose out on interest. Whereas if you do it with a money market fund, there's no lock-in period. You can withdraw basically anytime you want, and they will still pay you interest for however long you put your money in there. If you want to invest in money market funds and you're Malaysian, I think the best options out there right now is Versa Cash and Stashaway Simple. They both give around maybe 3.8 to 4% per year. And it's very, very easy for you to invest as well. All you have to do is just download the app, sign up, create an account, and then just deposit your money, and you should see it grow over time. I'll throw in a final wildcard option. This one is for Bumiputras in Malaysia, but you can also consider ASB or Amanah Saham Bumiputra. This one, technically, it isn't a cash investment because ASB, it actually invests in stuff like stocks, bonds, commodities as well. But the reason that I'm lumping this here is because the nature of the investment, how it works, it's pretty much like a cash investment. So first of all, the value of your investment here, it won't go up or down. Just like fixed deposits, the value of it will just stay the same. And the way that you're going to make money from this is that they will pay you a dividend every single year. So yeah, technically not a cash investment, but I would consider it a low risk, low reward kind of play. So yeah, if you're Bumiputra, check it out. The returns are pretty decent actually. It's one of the best ways for you to start investing. So now that we know our investment options, we've already narrowed it down to just two choices, stocks and cash. Let's talk about our investment split between these two asset classes. How much should we put in stocks? How much should we put in cash? So this one, there's no hard rule. It's going to be different for each individual because some people are okay taking more risk. Some people are not so okay taking risk. So for example, I'm someone who is very opposite of risk averse. I don't know what the word is for that.
Risk tolerance.
So I put a lot of my investments into stocks because I want to maximize my returns over the long run. But if you're someone who doesn't like to see the value of investments drop, like it causes you a heart attack or something like that, then maybe put more money into the low risk, low reward side, which is cash investments. You just gotta find the balance and then tweak it to your preferences. So to give you guys an example of how different the returns can be, an ETF like the S&P 500, which like I said is the most popular one, it has returned more than 11% a year over the last 10 years. Whereas if you put it into a cash investment, you expect to get maybe 3, 4, if you're extremely lucky, 5%. So yeah, there is a big difference in performance, but obviously any investment into stocks can drop in value. Investments into cash assets, usually they won't drop in value, and usually the risk is extremely low. So yeah, I'm gonna just talk through a general way of thinking how you can split your investments into these two assets. But like I said, don't just follow me blindly. Make sure you do your own research, make sure you understand yourself and how much risk you're willing to take, and then just decide on your own. Anyway, if you're just starting out, in my opinion, you should start out with building a solid foundation of cash investments. So these are for stuff like your emergency funds and any general savings that you might want to have. Starting out with emergency funds, the general rule of thumb is to have 3 to 6 months worth of your expenses saved up. The reason that I included emergency funds into my investments is because with my emergency funds, I don't actually like to just keep it in a bank account. I would rather invest it into a cash investment and let it generate some returns. With emergency funds though, I wouldn't put it into a stock investment because, you know, as the name implies, it might be for emergencies, so we might need this cash anytime. So we don't want to take any risk with it. So what I would do with this is maybe something like 1 to 2 months worth of our expenses in a bank account, and then the rest of our emergency fund in a cash investment like money market funds, fixed deposits. Maybe fixed deposits are not the best idea, or ASB. Those are pretty great options for you. And then if you want to have any general savings that you might need the cash in the next 1 to 3 years, let's say, so stuff like your planning for a holiday, or if you want to buy a house, or if you're planning to get married, you need to pay for your wedding. These are all savings that you want to build as well, and these savings we want to put it into cash investments because again, we don't want to risk this money. It's not meant for the long term, it's meant for the short term. So for me personally, once I have this part filled, basically any excess cash that I have will go to stock investments. Again, this is just my preference because I'm someone who likes to take risk, and the reason I'm okay doing this is because I'm still young, I'm still in my 20s, and I still have quite a ways to go before retirement. So I want to try and maximize my returns. Even if a bear market comes and the stock markets drop 40-50%, I'm still fine with it because I don't really need this cash now. I already have my cash investments sorted. All my savings are there. And that's basically the reason why I said that I would start off with building a solid foundation of cash investments. We want to have this here so that in case of any emergency, we don't have to sell our stock investments. Basically, anything that invests into stocks, I assume I don't need this money for the next 5 or even 10 years. What we don't want to do is keep everything into stocks and then an emergency comes up and we need to sell a stock when it's down really bad, and then we just lock in a loss. But I also know some people who like to have very little in cash investments. They basically want to maximize everything to just get as much money as possible. So they go full on stocks, or they even go even higher risk with crypto. Like I said, it's just personal preference. There's no right or wrong way to do this. Just make sure that you're comfortable with your investments and you don't lose sleep over it every night. If you're someone who is okay taking on risk, then maybe you can just follow me. Just have your general savings, your emergency funds all sorted into cash investments, and then everything else you can put into stock investments. But if you're someone who doesn't like taking risks, you feel like if you put too much into stocks and the value drops 10-20%, you're going to lose sleep, then maybe just put a bigger allocation towards cash investments. Even if you already have your emergency fund filled, you can just continue adding to that and just having more in general savings. So with all of this, you should have a pretty good understanding, or I hope at least that you have a pretty good understanding of how you can start your investing journey. But if you want to get into more detail, I also have a lot of other videos talking about specific investments. Like I have videos about ASB, I have investments about money market funds like Versa and Stashaway Simple, and I also have broker reviews. I also talk about investments in stocks and all those good stuff, so you can check that out. But anyway, thanks for watching this video to the end, guys. I really hope that you guys learned something from this. Let me know in the comments below if there's anything you're still confused about, because then maybe I can consider making follow-up videos for this. Anyway, give us a huge thumbs up if you enjoyed this video and subscribe to our channel if you haven't already. See you guys in the next one. Peace out.